The Fed has made it quite clear they want to do two more rate hikes over the course of the year. They want to do 4 in total. I still don't think there's any dynamic change in terms of whether it comes earlier or later. I think it's still going to come in the final month of each of the quarters and finish the year 50 basis point higher. I think all you're going to get out of the information we get between now and then is confirmation that this is where they're going, and yet the market is pulled back from that. So I think there is some risk at the front end of the Treasury curve where the 2-year notes probably have to move up another 10 to 20 basis points.
So the conversation in the second half of the year is going to be about the yield curve inverting. What that might mean, we could flip a coin on that. But what do investors do with that conversation? Because it's going to be a headwind.
Well, I mean, the reality is the curve is going to invert. Every long business cycle, there are 2 inversions. It's not going to go to a strict inversion. To me, it's going to go to 0 between 2s and 10s this time through, which is exactly what it did in the 1990s. But that starts the end of the business cycle clock. There are 3 long business cycles, the 60s, the 80s, and the 90s. The average time from the first inversion to the second inversion, which brings about the end, is 1.5 to 3 years. So that starts the countdown going for when the end of the business cycle. So it doesn't
necessarily equate to an immediate recession. It means it's more of a warning signal to the investor.
It is, but it will probably, because there are asset liability mismatches that will come to the surface as a result of the curve flattening.
Like what?
Well, I mean, there could be a number of things. For example, I'm very, very concerned about what's going on with GE. I mean, here's a company loaded down with debt, and every time they sell a cash-producing asset, the equity investor base goes out and applauds, and meanwhile, you're creating an inverted pyramid where you've got this high level of debt and less revenue to support it. And this is the thing that eventually goes unstable, and it amazes me the rating agencies haven't pushed on GE yet. And I think one of the reasons why they're concerned about it is that the entire credit market could reprice on the fact, because when you guys have to trot out corporate America, who do you bring to your table? Jack Welch. And Jack Welch single-handedly destroyed that company.
From a stock market standpoint, though, Ryan, from a stock market standpoint, the market is not filled with scores of GEs. The market's filled with scores of companies that have plenty of capital on their balance sheet, that have recapitalized in recent years thanks to low rates. So what would an inversion of the yield curve signal to the stock market as opposed to the economy, which is what Steve just outlined? We actually just lost Ryan.
He left.
He left.
He left.
He didn't like the Jack Welch comment.
Yeah, I just want to go back to that. I know it's a little off topic because that's not where we were going, but you lay this at the feet of Jack, not Jeff.
Well, I think
Jeff was an immelt.
I think Jack left the company in the wrong environment for what was going to happen, and I think Jeff tried his best to correct it. But once you get into these kind of established processes, where think about it, for GM was going downhill for years. Yet anybody who came in who was smart couldn't correct it, because this is established internal mentality that becomes very hard to turn around.
I disagree with everything you just said.
That's fantastic.
As I usually do with your economic analysis as well. But you're entitled to your opinion. Poor Ryan. I feel bad for him.
He took off.
He's gone. Anyway.
He's back. All right, Ryan, so from your standpoint, we were just talking about the inversion of the yield curve. What does that mean for stock market investors? Once we invert, I mean, we're at 30 in terms of the spread right now between 2s and 10s, just about. When we get to inversion, what does that signal, if anything?
Well, first off, Melissa, I'm glad to be back. Sorry about that there. The joys of live TV, right? You talk about the inversion of the yield curve. Let's not forget what's going on with the rates. We have a flat yield curve, flattest in a while, we all know that, but rates are going higher. The last time we saw the yield curve this flat with rates going higher was 1994-95. To us at LPL Research, we think the fact that rates are going higher, and that is more of a positive sign. And we all know, we're not inverted yet, right? So historically speaking, when the yield curve right before it inverts, you could have 6 to 9 months of really good equity gains. So yes, it's a concern. There's still a lot more major positives out there, specifically repatriation, bringing cash back, using CapEx to invest in companies in themselves, and those earnings that you guys just talked about continue to be strong. So overall, the second half of this year should continue to be good for equities. We're not super concerned about the yield curve yet.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.